Inflation doesn't steal your savings all at once, it bleeds it quietly. Here are the 5 things that matter. Protecting savings from inflation starts with avoiding the common traps that make people feel safe while they slowly lose buying power. If you only compare your rate to inflation, you'll chase headlines instead of building a plan you can live with. If you chase APY above everything, you can end up parking money where you can't reach it fast. Safety isn't automatic either. FDIC and NCUA coverage has limits, and fees can wipe out interest. Most important, one single savings bucket forces bad trade-offs. The right inflation defense depends less on the highest yield and more on matching your money to time and access. Your time horizon drives how much risk and lockup you can tolerate, because money you need in 30 days can't be treated like money you won't touch for 2 years. Liquidity has a price, so the more instant access you demand, the more yield you usually give up. Guaranteed returns, like a CD, behave differently than variable returns, like many savings rates. When yield lags inflation, purchasing power drops, and complexity often hides fees that accelerate that loss. Think of your accounts like tools. Each one does a different job, and inflation punishes using the wrong tool. Checking is for spending and bill pay, not for storing cash long term, because many checking accounts pay near zero interest. Basic savings works as a small buffer, but it's often not designed to keep up with rising prices. High yield savings aims to pay more while keeping your money liquid. Money market accounts can add limited check access, while CDs trade access for a locked rate. Treasuries add another option, backed by the US government. A practical way to stay ahead of inflation is to split cash by purpose, then choose the account that fits that purpose. Keep a bills buffer in checking so you never overdraft, but cap it to a realistic monthly amount. Put the true emergency fund, often 3 to 6 months of expenses, somewhere liquid that still earns, like a high-yield savings account. For short goals, a money market can work if you need easier access. For a fixed timeline, a CD ladder spreads lockups across several dates. If you hold large balances, split them to stay within insurance limits, and if you're uncertain about cash needs, stay liquid. Inflation protection can disappear fast if you miss the fine print, so you have to run the leak checks. A maintenance fee is a tripwire. $10 a month is $120 a year, which can erase a lot of interest on a modest balance. Transfer limits still exist at many banks, and they can matter in an emergency. With CDs, do the penalty math before you lock up money, because early withdrawal can eat months of interest. Interest is taxable income in most cases, so your after-tax return is what counts. Confirm whether your account is covered by FDIC or NCUA and which category it's in, and remember, joint accounts can increase coverage, often by effectively doubling it. A $10 monthly fee is $120 a year, so even a good rate can lose to inflation after fees and taxes. BankingHub matches you based on how you actually bank and shows the real dollar impact for your balance. Free, takes 2 minutes, and the link is in the description.